Hello everyone, in this video I'm going to go over fair value gaps and why they are important in trading. So, I don't really know why this phone reminded me of a fair value gap. I don't know if it's just me, but you might understand as we go into the video and when you actually understand what fair value gaps are. Getting right into it. What is a fair value gap? FVG, don't let that confuse you, just stands for fair value gap. So what is a fair value gap? A fair value gap is a void in price range where there are no contradicting orders. What is a fair value gap? Fair value gap is a void in price range where there are no contradicting orders. Make sure you write that down because, well, it's all going to make more sense when we get into the first examples. So right here, as you guys know by now, there's bearish and bullish. This would be a bearish fair value gap because we had bearish price action. So a fair value gap is a 3 candlestick pattern. It's a 3 candlestick pattern where there are no resting buy orders. Well, no, there's no resting buy orders in bearish fair value gaps, and there's no resting sell orders in bullish fair value gaps. I don't know if that makes sense yet, but let's get more into it. So there's a lack of orders within the market. So you can usually find fair value gaps when there's a large move either to the upside or to the downside in price action. So right here we could say that we had a move to the downside. We had bearish price action. So we had a 3 candlestick pattern to the downside and we created a gap, which is a fair value gap. Now, how do you identify this fair value gap? So a fair value gap is when there's 3 candlesticks. 1, 2, 3. These are all bearish. Do I need to shade it in red for you guys? Okay, there you guys go. I don't really know if that helps. It just really pisses me off how, well, when I was just starting, the colors would always confuse me. The colors don't matter at all, but the colors would always confuse me, and that's why, just in case you guys are really just beginning, I'll make it as simple as possible and how I wish I was being showed it. So, bearish candlesticks. Wicks. You need to know the wicks for this. We already went over wicks. If you watched my previous videos, you already know what wicks are. So, the body is a rectangle, and then the wicks are the little things coming out from each side. So, the middle candlestick is where the gap would actually be. So, you can see that the fair value gap would be in between the wicks of the first and third candlestick. So again, there's 3 candlesticks and the wicks that are coming out from the first and third candlesticks. So here we have the first one. You can see the wick coming down here, and then the third one's here. The fair value gap would be in between this space. It would be from the space from this area to this area. That's the gap because that's where the wicks are from the first and third candlestick. That's what the gap is. That's what the fair value gap is. Now, here it was just a drop to the downside without any hesitation. It was a big drop to the downside, which created a liquidity void, which is just a fair value gap. And there's no resting buy orders. It's a bearish movement, and it was just a big move to the downside without any hesitation, which forms a fair value gap. There are lacks of orders within the market. Alright, now I'm gonna make an example of a bullish fair value gap. So while I'm making this, I want to go over why these are so important. Fair value gaps is just something that I specifically use a ton. I use fair value gaps all the time. If you're using my strategy or the PB strategy or almost any strategy, you're gonna need to know what a fair value gap is. Fair value gaps are one of the biggest building blocks that I look for in my strategy, and it's overall how I get entries. So it doesn't matter if you're using my strategy or not, you're gonna need to know what a fair value gap is, and that goes with almost any building block. You need to know it all. Okay, some you may not need to know as much as others depending on your strategy, but you still need to know them all. You need to know how they all work, you need to know what they mean, what they do, what they show in the market, because everything has a part in the market. Some things can be used for confirmation, some things can be used to just find an entry, or whatever it is. Okay, this would be an example of a bullish fair value gap. As you can see in the first and third candles, we have a wick here, a wick here. The gap in between the wicks would be the fair value gap. Simple as that. Here we had a strong move to the upside without any hesitation, creating a void in the middle, a liquidity void, and there were no resting sell orders. So, since the move to the upside was so big, there were no sell orders in between the space that we marked out. So, why is this important? A lot of the time, whenever fair value gap is formed, and the reason that I use them so often and almost everyone uses them so often is because it can be used as a retracement tool, or it can be used as a way to get a retracement. So bullish price action, that's what we have here, a bullish fair value gap. A lot of the time, if we're going bullish, price will like to retrace into this fair value gap and then retrace out of it. Okay, we'll get deeper into that later on as we go, and especially if you watched my strategy video after this, you'll have a better understanding of what I mean by this. But right now I just want to go over what they mean and what they do. But a lot of the time we can just look for an entry by filling back into this fair value gap, and which constantly happens because there were no resting contradicting orders in this gap, which is why oftentimes we get a retracement out of it, or sometimes we'll get an inverse fair value gap, which is where price just disrespects that fair value gap and retraces lower. But that's something for another video. When talking about fair value gaps, don't let the name confuse you, because normally people just use fair value gaps, but sometimes you'll hear imbalances, liquidity voids, whatever it is. You may hear, I don't know, but fair value gap is the one that you're going to most oftenly hear, and just don't let it confuse you. Basically, quickly going over it one last time before we go to in-chart examples. Bullish fair value gap, we had a strong move to the upside without any hesitation. The middle candle is the candle that creates the actual imbalance, and then the first and third candles, you can use the wicks to see if there actually is a fair value gap, because let me show you an example of what a fair value gap is not. This is not a fair value gap, okay? Because the wicks overlap each other. The first candlestick's wicks and the third candlestick's wicks overlap each other. Not a fair value gap. You can't get any space in between those. But if it's like this, you have clear gap in between those wicks where you have a fair value gap. So the wicks cannot overlap like this. There has to be space for a gap, which is where you'll find a fair value gap. Now make sure you don't take trades just off fair value gaps, or almost just any one building block. You want to have a set of building blocks or confirmation or whatever your strategy is on. You'll figure out your strategy later on as we go, and if you're interested in that already, I do have a video out on the strategy that I use, and I clearly explain how it works. So about fair value gaps is that the size of the fair value gap does not matter. So it could be a small gap, it could be a big gap. It does not matter the size. I actually used fair value gaps in a trade that I took today. Well, almost every single one of my trades is based off fair value gaps, but it was an inverse fair value gap. It was just a small short that I took. I had a $350 profit, nothing crazy. But it was an inverse fair value gap, so that's something we'll get more into later. I could have looked for continuation, which would have been much better than the short that I took, but doesn't matter. I made profit and I wanted to save capital, so I didn't try and go for more continuations after I took that trade, because as you can see, price consolidated for the rest of the day and is now consolidating in Asia session. So I'm not mad. I'm glad I took the trade and I had a profit. So looking at our first example here, we have a bearish fair value gap. You can see this fair value gap, and there was a big move down. This is on the 1 hour time frame, and you can see the 3 candlestick pattern right here. 1, right here, 2, and then 3. The third one's the small one down here, middle, first. So let's mark the fair value gap. The fair value gap would be marked from the first candle's bottom wick to the third candle's top wick. You see, that's our fair value gap right there, because it's in between the first candlestick's bottom wick and the third candlestick's top wick. As you can see, we had a big move to the upside, which means we most likely can find a fair value gap in that move up. So first top wick right here, third bottom wick right here, imbalance in the middle candlestick, and we have a fair value gap. This is a really easy concept to grasp and overall an easy building block to understand, and I don't think it takes that much thought really, and it's really easy to spot them. So now let's go over an example of what a fair value gap is not. Right here you can see we had a move to the upside, as I just marked out. Right there we had a move to the upside. We had 3 candlesticks, 1, 2, 3. But, well, take a second to try and think yourself, or pause the video and think to yourself why this is not a fair value gap. So if you said because the first candlestick's upper candle wick and the third candlestick's bottom wick overlap each other, then that's right, because there's no space, or there's no actual imbalance in this 3 candlestick pattern. There's no space to mark a fair value gap, because this wick goes up to here, and then this third candlestick's wick goes down to here, so they overlap each other, which is not a fair value gap. Right here we have an example of a fair value gap getting respected. Let me mark it out for us. Right here we had a bullish fair value gap, this 3 candlestick pattern right here on this move up with a tiny leg up, and it got respected because you can see I marked out the fair value gap for us, and then we had a tiny move down. The candle closed inside the fair value gap, and then we retraced higher. This is why it's often used as a retracement tool, because we formed the candlestick, and then for the fair value gap to get we formed the fair value gap, and then for the gap to get respected, we need the candle to actually close inside the fair value gap. It can't close underneath the fair value gap, and it can't just be the wick that gets inside the fair value gap. The body itself needs to close inside the fair value gap for it to get respected. And then after we respected that gap without imbalance, we had a strong retracement to the upside. That's a very clear example of a fair value gap getting respected. Now let's try and find a bearish example. Okay, here we have a bearish fair value gap that was formed. There was mostly the middle candle that was moved, but it was the imbalance, and this is on the 4-hour time frame, so it's a much higher time frame, which, you know, higher power means higher power. And here we had a 3 candlestick pattern, 1, 2, 3, and then we marked out the fair value gap in the imbalance in between the first candlestick's bottom wick and the third candlestick's top wick, creating an imbalance. And then as you can see here, we had a move into that fair value gap, and the candlestick closed inside the fair value gap, and then we retraced lower. So we respected that fair value gap, since the body of the candlestick actually closed inside of that gap. Hopefully now you have a much better understanding of what fair value gaps are, and you can add them into your everyday trading, and especially if it goes along with your strategy. And make sure, if you don't have a strategy yet, make sure to check out the video that I posted on my strategy, because I really clearly go over every step I take in my strategy and what you can do to actually find your own strategy. Maybe now the phone emoji that I added here actually makes sense, you know, because it's like a gap in between. It's like a 3 candlestick pattern. I don't know. But hopefully that all makes sense, and you now understand the importance of fair value gaps.